Hi, welcome to Trigonometries. Today we're going to look at cumulative annual growth rate and how to calculate that. The cumulative annual growth rate, or CAGR, is a tool in economics that helps us understand how fast an investment grows, sort of on average. The basic premise is that you can have an investment like a stock or something like that. And when you put money into it, it's going to rise and fall with the ebbs and flows of the stock market. Sometimes it's going to be up, sometimes it's going to be down. And it's not a particularly super predictable pattern. But if you've had this investment running for a while and you want to compare it to, say, another investment that's been running for a while, you kind of have to have some way of being able to compare the two investments and to see which one's better. And so what CAGR does is it has this, they call it a smoothing effect on the sort of volatile movement of an investment. And the way it does it is it basically says, if this had been a smooth investment that had always gained the same growth rate, like say I put it in a bank account, what would the interest rate in the bank account have had to have been in order to produce the final value of the investment that I observed? And this gives you a way of then comparing two different investments that may have a lot of noise in them, because you can kind of see what would have happened if they had both been a smooth bank account that you just put money in and had an interest rate, because you could see which one had a better interest rate over it. So to take a look at this, let's explore this problem a little bit more. So in this spreadsheet here, I'm going to put in my first column here the initial investment. That's the initial amount. And then over here, I'm going to have the ending value of the investment. Over here, let's put in how many years I had the investment. Let's make these two values currency. So say your initial investment was $15,000 and afterwards you had $50,000. And let's say that this investment ran for 15 years. The question here is, how good is this investment? Now this might have been like a stock that goes up or down. In order to understand how good of an investment this is, we'll pretend that it was a bank account with an interest rate. And what we want to find is what that interest rate would be. Now, if you watched my previous video about population growth and compound interest, you know that if you had a compounded interest investment, the current value of that investment is equal to the principal value times 1 plus the annual percentage rate divided by how many compoundings a year you have. That whole quantity will be raised to the number of years times the number of compoundings. And if you want to understand why this is the right formula, you can check out the video that I talked about this in, which I'll link in the description. Now, let's just say it's a bank account that compounded annually. So it's just one time a year. That simplifies this formula a little bit. We can just set the number of compoundings equal to 1, and we end up with the current value is equal to the initial value times 1 plus the growth rate raised to the number of years. So if you notice, the three pieces of information that we have, though, is what the initial investment was, what the current value of the investment was, and the number of years. What we're looking for is the growth rate. And so we're going to use some algebra to solve for that growth rate. So what we'll do is we'll first divide by the initial investment, so that we'll have on the left-hand side, the current value divided by the initial investment will be equal to the quantity 1 plus r, where r is the growth rate, raised to the number of years. We need to get rid of the number of years in the exponent, and so we raise it to the 1 over t power. So now we'll have the ending value divided by the initial investment raised to the 1 over t power, where t is the number of years the investment lasted, is equal to 1 plus the growth rate. To solve for the growth rate from here is pretty simple. You just subtract the 1. And so then the growth rate that this would have to be, if this were a compounded once per year kind of bank account, is equal to the quantity of the ending value divided by the initial value raised to the 1 over t power, where t is the number of years in the investment, minus 1. Now this is a rate. It's going to be like a fraction. So if you wanted to turn this into a percent, you'd have to multiply this by 100. And so depending on where you read about what the CAGR is, it either converts it to a percentage or it doesn't. And you'll see that by whether or not it multiplies this final value by 100 or not. We'll just leave it as a growth rate for now and hit the percent button in order to get the percent out, rather than multiplying it by 100 ourselves. So here on this, we're going to make the CAGR. So to cook that up, we're going to say equals, because it's going to be a formula. It is going to take the ending value, B2, and it's going to divide it by the initial investment, A2. It's going to raise this to the power, I got to put parentheses here, of 1 over the number of years, which the number of years is in C2. And then I'm going to subtract 1 from it. And that should be the CAGR amount according to the formula that we had. If I hit enter, I get a weird decimal, but what we'll do is we'll convert that to a percentage. And so basically what this is saying is that if this investment, which started with $15,000 and ended with $50,000 after 15 years, if we had pretended that that had been an investment in an account that gained interest once per year, the interest rate that it would have had to have in order to produce this amount of growth would have been 8.36%. And we can add this down and take a look at a couple of other investments. So if we want, we can have another initial investment. Maybe it's $30,000. And let's make all these dollar amounts. And let's say after 30 years, it's worth $75,000. If that were the case, the annual growth rate would have had to have been 3.1%. And so if you were looking at sort of these two investments, you could compare the CAGRs for them and you would find that this second account was a little bit worse than the first account. And so if you were planning on where to put your money, you'd want to put it in the first account. Similarly, let's do another one where we have maybe an initial investment of $10,000. It produces $66,000 after 23 years. That's an 8.55% account. And so that one, we would have been better off investing our $15,000 into this account instead because it gets a better annual growth rate. And that's pretty much it for how to use the CAGR in order to calculate the annual growth rate of a particular type of investment. You can think of this value as kind of the average growth rate or the growth rate required if you were to put it in a bank account that is compounded once per year for interest. What would the interest rate have had to have been to produce the same investment? And that's it for today on Trigonometries, and we'll catch you next time.